Shell recently announced that it intends to buy Volta, an EV charging company, for $169 million. And I argue this deal can either be a steal of a deal or it might be pure folly. And as usual, only time will tell. In this video, we'll go through some of the reasons why the deal might be great or why Shell may fall on its face in this particular endeavor. This is part of a broader transition for Shell to try to find ways to pivot away from oil and gas and into the renewable energy and low carbon energy sector. One thing that Shell has already done, for example, is shut down its big Convent refinery on the US Gulf Coast. It was a massive refinery, refined over 200,000 barrels per day of crude oil. And Shell, it looks to be, is going to turn that facility into one that can produce renewable diesel and sustainable aviation fuel. So the reason I bring that example up, A, it's one more example of Shell trying to pivot away from these legacy oil and gas assets. B, this sort of pivot comes with a real cost. Shell is exiting assets that are economically productive, that really do generate plenty of cash, plenty of profits for the company, and steering into less proven technologies that at the moment are not nearly as financially lucrative. So the Shell Volta tie-up is in this theme. It's something that Shell finds to be an existential effort, much like many oil and gas majors, to figure out how do you pivot your way through this energy transition. And this potential Shell Volta tie-up, I think, is a very interesting one for us to take a look at to get a sense of how this might play out at the interface of oil and gas and these new energy technologies. Let's start with a little bit about Volta. The company went public in August of 2021, and currently, as of the last filing, it has about 3,000 charging stations across the US. Now, it's an interesting technology because while these stations very much are EV charging stations, they're also connected into massive screens, and these screens run advertisements. And this advertising revenue is about 80% of Volta's current revenue stream. So it's easy to think about Volta being an EV charging company and think, okay, they must be generating revenue off that kind of operational reality. And frankly, they're not. It's largely an advertising company that uses EV charging to connect customers with advertisements. That's not the long-term play around Volta, but we want to be clear about what its current business reality is. In the first 9 months of 2022, the company generated $38 million of revenue. And that is against an operating profit of negative $146 million. That's right, an operating loss of $146 million. That means that Volta had an operating margin of negative 385%. And that is as painful as it sounds. What it means is the company is spending much more cash than it is generating even revenue in return, much less profit. Now you can hear that, and the positive side of that story is this is how capitally intensive businesses get off the ground. You have to put a lot of money into them in order to scale them up to the point where then their revenue can start to cover their ongoing cost base. So you make a lot of expenditures up front with the idea of capturing a lot of cash and profit on the back end later on. That is much like how Tesla started. It's much like how Amazon started. Uber, you get these stories of losses up front, profits on the back end. And of course, that's the hope with Volta, but it's a very different business environment right now. It's a very different operating model for Volta than it is for these other companies. So it is speculative at best whether this huge volume of upfront expenditure will get paid back in all of these profits that we expect to see further down the line. Volta's cash situation is equally eye-popping in the negative direction. In the first 9 months of 2022, Volta spent $180 million to run its operations. And that's effectively the reverse of how almost any profitable business runs, which is you run the operations in order to generate cash from the business. For Volta, we are spending money to go run that business because the revenue doesn't come close to covering the expenditures that we have for running that business. So there's a big cash drain going on there. And at the end of September of 2022, Volta had a cash balance of $16 million, and their quarterly operating costs were $55 million. So you get a pretty good sense of what the cash pinch looks like for them at the end of September. They have less cash in the bank than they need in order to run the business for even a full quarter. As you would imagine, there was a lot of talk on the earnings call for Volta because it's a publicly traded company. There was a lot of talk on the earnings call about what are you going to do about this cash situation? A, how much cash are you actually spending week to week, month to month, quarter to quarter? B, how confident are you that you're going to be able to pull cash in from new investors or take on new debt? It's clear that you need cash to come into the business in order to continue to run the business this way. And the Volta team didn't have a whole bunch of answers. Their answers were more of the line of, yes, we're having these conversations. No, we're not prepared to report on any of this publicly. But when we have more clarity, we'll share it with you. So when you take that circumstance that Volta's management team and investor community found themselves in, it's not surprising that shortly after that earnings call, you have an announcement where Shell says, yes, we would like to buy the company for $169 million. That is the cash infusion that Volta needs in order to keep operating its business, as opposed to just shutting it down. If you run out of cash and you just can't keep fueling the enterprise, then there's no other choice but to shut it down. So in this sense, Shell is an investor of last resort for Volta, which makes it kind of a surprising outcome to see. It should be pretty clear at this point how this deal could wind up being pure folly. Shell is spending $169 million to acquire a business that consumes cash nearly endlessly. And there's a lot of work to be done to steer this thing around where it can generate enough revenue to even start breaking even profit-wise, much less generate cash on the back end, profits on the back end. So that's the risk that Shell is taking. It's plowing hundreds of millions of dollars, over $100 million into an enterprise that has already consumed well over $100 million to run the thing. And it's kind of easy to imagine how that could end up going badly for Shell. At the same time, this really might end up being a steal of a deal for Shell. And here's one important reason. Volta has $126 million in charging assets as of its last public filing. And it has another $96 million of construction in progress. So you can think about it as Shell having spent $169 million to buy $222 million in tangible assets. And that's a pretty good deal, right? Shell's buying them for less than a full dollar per dollar of assets that it's buying. And what that means is it's getting all these intangible assets for free. And you can think of intangible assets like the customer relationships that Volta already has. The know-how that Volta has in terms of how to trade regulatory credits, say specifically in the California energy markets. So these kinds of things Shell is able to import directly for free from Volta while spending less than a dollar for every dollar of tangible assets it's getting. Now, it's not quite a slam dunk in that sense because Shell is also taking on Volta's debt. It's also taking on Volta's operating liabilities, and those are to the tune of $120 million. So it could be pure folly in the sense if you think that Volta is going to just continue to consume Shell's cash, plus the cash that Shell is offering upfront in order to purchase the thing. But you can also imagine it's going to be quite a steal for Shell to be able to buy these assets for less than it cost Volta to actually build them up themselves and getting these additional assets for free in a sense. For the strategic implications of this deal, it's really a matter of, do you think this EV charging sector is a land grab? Or put differently, is it that important that you go get the most attractive charging locations you can? With the idea that there's probably a power law distribution, the most attractive charging locations are much more valuable than, say, the middle tier charging locations, and certainly the lowest tier charging locations. So if you believe that Volta has disproportionately attacked the most valuable charging stations first, which would make a lot of sense if you're trying to generate as much revenue as you can initially, then Shell may be buying into locations that otherwise wouldn't have been readily available to them. And that's sort of the strategic plus of Shell engaging in this way. Also on the financial side, it's important to put this all in context that in 2022, Shell generated over $45 billion of free cash flow. There's no scenario where a $169 million purchase plus another $100 to $200 million a year they may pump into Volta before it starts producing economically on its own is going to sink Shell. It's just nowhere close to that. So you could think in the landscape of Shell, this is a small stakes bet that may have enormous upside on the back end. And so it's pretty easy for Shell's management to write a $169 million check to make this happen. Still, even though this won't be a ruin for Shell if it goes badly, it may wind up being quite a poor deal for them, or it may be a home run. It's something that only time will tell. I personally find it fascinating to watch this space. I hope you do too. Thanks a bunch for stopping by, and I'll see you next time.